Hi everyone, this is Sasikan Haskell, and here we are at the waterfall called Nam Tok Tat Mok in Chiang Mai, Thailand. What I am showing right now, this is the top of the spectacular waterfall that we saw earlier. So we came to the top, and yes, above the spectacular waterfall, it's just a tiny brook. Okay, and here I am having Attorney Haskell, who is going to discuss the tax issue some more in continuation of his talk earlier. Here's Attorney Haskell.
Hi, I'm Attorney Louis Haskell, sitting high atop the Tat Mok waterfall in Chiang Mai, Thailand. And I wanted to talk some more about the 20% deduction for pass-through entities that is such an important part of the new tax law. And in particular, I wanted to talk about the provisions for what are known as specified service trades or businesses. Because although we are entitled to this 20% reduction, we do have more restrictions than everybody else. I suppose the threshold question then is, what is a specified service trade or business? This is a term that's been in the Internal Revenue Code for over 20 years and is not particularly well defined. However, some things are clear. It includes attorneys, doctors, accountants. It includes anybody in financial services, so that would include tax preparers, it includes insurance people. It includes every manner of consultant. The original term includes accountants and engineers, although they were specifically excluded from these restrictions that I'm about to talk about. There is a provision in this law, however, that includes any business whose principal asset is the skill or reputation of one or more of its employees. So, and because it is service trade or business, it could potentially be a very broad group of people, or not. There are a bunch of cases hitting their way to the tax court on this issue, and so we will have greater clarity in the next couple of years. However, for a lot of us it is clear. It's unambiguous, for example, that I'm included in this category. So what makes us special? For people who don't make a lot of money, nothing. If your taxable income is $100,000, there's no issue but that you can deduct 20% of your qualified business income. If, however, you are married filing joint, you have a cap of taxable income of $315,000. For everybody else, that cap is $157,500, which is half. At that point, that 20% offset begins to phase out. It phases out over $100,000 for married filing joint and $50,000 for everybody else. And so, if you are, say, an attorney who's married and whose taxable income on his joint return is $415,000 or more, you get nothing. Similarly, if you're a single doctor making more than $207,500, which is to say that $157,500 plus $50,000, once again you get nothing. It completely phases out. The phase-out rules for service providers are very complicated. So complicated, I'm really not going to go into them in detail. But they are a function of your payroll and of your capital investment, perhaps. So, for example, for me, where the law office of Louis S. Haskell employs a lot of people, it has a very large payroll, my phase-out is relatively favorable. I get the full benefit of the phase-out rule. For a consultant who has no payroll and no capital investment, however, the phase-out rules are very draconian, that it phases out very quickly or very dramatically. And there, I think what's going on, of course, is that there is a desire within the new tax law to encourage job creation and these sorts of things. And so, and as we'll see with the other businesses, payroll is important, but for us, it only kicks in as part of our phase-out rules. So that basically, in a nutshell, is how specified service providers are treated. And look, for those who are making less than that $315, it is a wonderful, wonderful deduction. Thank you.